On today's hot sheet, I'm discussing housing inventory for the past week. 22 states at risk of economic recession. Are you in one? And a 16-year high in home builder unsold inventory. Today is Monday, October 13, 2025. I am Byron Lazine, and the hot sheet starts now. Okay, live from Naples. Happy hot sheet week here. I don't know, Bobby, maybe you can check. I think the stock market's open today. I know when we just did the role play mastermind that there's a holiday today, so I know some school's off, but I think the market is open.
The market is open today.
Stock market's open. That means the hot sheet is open every Monday through Thursday that the markets are open. We bring you the only live housing show on the internet for real estate professionals. Make sure you subscribe to the YouTube channel so you don't miss one. Let me know in the live chat which market you're tuning in from, and let's jump into it here. We've got a market open after a market pullback on Friday after a Trump Truth Social post regarding China. Looks like today, yes, the market is open and there is a significant rebound. We've been talking about on the hot sheet for a long, don't get hysterical about trade war talk. Don't get hysterical about tariffs. Those that have been hysterical saying end of the world, end of the markets have been proven to be pretty dumb time and time again. I'm not saying tariffs are good. I'm saying don't get hysterical about them. What I'm saying is these things are fluid. They change quickly, and we're already seeing the markets change. What we're not seeing change is weekly inventory to the extreme upside like we thought we had it earlier in the year. Okay, if you remember, at one point this year, we had housing inventory, single-family inventory per Altos Research at over 30+% year over year. That was the heart of the spring market. Okay. Now here today, as if we are, as we sit here for the fall market starting to pick up here, we're only at 17% more than last year on inventory. Okay. So 17% more than last year. We were at a certain point, we were up over 30%. This past week, we saw inventory fall. Okay, inventory goes from 863,000 to 856,000. If we go back to July of this year, okay, the fourth week of July, what do you know? We had 856,000 single-family homes actively on the market. For the past 3 months, we've been basically where we've been at on single-family active listings. We haven't moved. Where last year, during these same 3 months in late July, certainly August and September, into October, we saw an acceleration of active single-family inventory onto the market. Had we seen that this year, we could have crossed 900,000+ single family existing homes on the market. Now, we're definitely not going to get there. Last week, I said, that's it. The inventory increase that we were hoping for through the fall market to continue to put downward pressure on prices. Everybody wants more affordable. How do you get it? We talked to Barry Habib on Knowledge Brokers podcast on Friday, separate channel. Go check it out. Barry Habib is a Fannie Mae board member now. He's on the board of directors. He's obviously just a legendary name in the mortgage space for decades. He gets this stuff right more than anybody. He's talking about, hey, like, we know what pushes prices down. It's supply. Well, that supply isn't going to support this dramatic drop on prices. So what do we have to focus on? What I've been saying for months, we have to focus on these lower rates if you want a more affordable option. I know this annoys a whole bunch of the TikTokers and those on Instagram saying, hey, let's tear down the financial system because that's the only path forward. No, it's kind of just ludicrous, silly, childish, never going to happen, a dumb idea, etc. You're not going to tear down an entire system because you have an Instagram account. No, you have to let the market work itself out. We're now at a more normal market on inventory. We've made strides here on inventory for the year. That's a good thing. It has put the more supply somewhat of a downward pressure on prices, where prices are finally moving flat. They've stabilized. We're more normal than any point we've been the last 3-4 years on our housing inventory across the board. We're not at 2019 levels yet. If we go back to 2019, yeah, we were higher. We're in the seasonal decline. We'll end the year lower. And that's just kind of where we're at, continuing to crawl out of this dramatic inventory decline. But we're at a better place. It's more normal. We're just not going to see the level of inventory that maybe we had hoped for earlier this year. Why? Sellers don't need to do anything. As many IG posts as those doomers put out saying, hey, prices are going to come down and we need to tear it all apart and start over, the sellers are saying, dude, I don't have a mortgage. 41% of them don't. I don't need to listen to your crap. I own my home free and clear. I'll enjoy it, and I'll scroll right past you while I'm sitting in my sauna. Like, I just don't need to listen to this stuff. And so there's not an incentive for sellers to go and fire sale their house. The only incentive is dramatic increases in inventory, supply, lessening demand, but a supply category where sellers actually have to sell, not would like to sell. And you're not seeing enough of that right now. Now, maybe some type of market, greater dynamics, and economy shift would, in fact, get more sellers to say, yeah, I have to sell. We're going to talk about that here in just a minute. First, let's take a look at new listings for the past week. New listings come in at 64,000, not unlike the week from the year prior, where we saw 63,000. So we're not seeing an increase, even though we don't have the government data from the shutdown. We have private data that suggests, yeah, we're not seeing much, different job dynamics than we've seen in weeks prior. Okay, there's not, just because the government shut down doesn't mean we're blind to the fact of what's happening in jobs. We do have private data. Now, the job market is weakening. But we're not seeing a mass layoff happen across this country until you see that, or unless you see that, not predicting that in any fashion, but unless you see some type of massive layoff, which would probably come with some other greater, economic shift, you're not going to see a whole bunch of sellers saying, I have to sell, would like to sell for, reasons of lifestyle or what have you. Is much different than have to survive. Okay. These are the sellers with the price reductions happening right now. We got about 42% of percentage of sellers that are reducing before sale. Last year at this time, it was 39%. That number is up. So you do have a seller who would like to get this done, a little bit more of an aggressive seller than what we've seen in the past. Still, not a seller that has to do anything across the board. For mortgage application data coming into this week, we've had 19 positive readings on the year, 14 negative, last week being one of those. When you look at the week over week stats, flat prints is 6, 36 straight weeks of positive year over year data. Basically, the whole year has been positive year over year, and 23 consecutive straight weeks of double-digit growth year over year. So mortgage applications doing much better than this time last year. Still nowhere near what you would consider normal times. These are still at the levels of a GFC and levels of the mid-90s as it relates to mortgage applications. You have to come off the mat at some point and start lifting yourself up. That's what mortgage applications appear to be doing. We'll look for more improvements going into next year. Barry Habib on Knowledge Brokers podcast suggested that you could get a tailwind on that with the 30-year fixed rate, saying, hey, it could be as low as mid-5s next year. It's one of the more bullish projections that I've heard. Go check out Knowledge Brokers podcast because the conversation was fascinating. I'm rooting for Barry's projection I don't think that's his firm final projection, but kind of where he's at looking next year, that, yeah, it could get as low as the mid fives in 2026 in the 30-year fixed mortgage. That would bring a greater recovery effort to those mortgage applications and buyer demand. Pending home sales has improved with the slight improvements on the 30-year fixed mortgage. 63, almost 64,000 for the week. Same week last year was just over 61,000. We are seeing a longer timeline from pending to close and higher cancellations. So we'll see where that goes into the future. All right. Fortune magazine covered a story on the economy. Okay. This is an analysis from Moody's Analytics. Watch out for Fortune magazine's headlines, because Fortune will typically write really clickbaity headlines. Fortune magazine has been known to be a rag of sorts when it comes to how they cover these topics. Moody's Analytics, though, is respected in a lot of areas as it comes to economic analysts. And the analysis from Moody's is that in 22 states right now, they are seeing their economies contract. Okay. So Moody's is saying 22 economies, 22 states in the US are in a recession right now. 16 states, meanwhile, are seeing economic growth, and 13 states are just simply treading water. Okay. Now, a state like Maine is not really as important as a state like New York. I'm sorry for my maniacs, but in the greater scale of our economy, as it relates to like moving the country forward, Maine's a great place for the summer, but it's irrelevant and unserious as it comes to our economy. When we're thinking economy, we're thinking New York, we're thinking California. Those two states make up just about 20% of the GDP of the country. Okay, what's happening in New York, what's happening in California is kind of where the rest of the country is going to get their cues from. After that, you have the Floridas and the Texases of the world, for sure. But those two states making up a fifth of our GDP here in America are going to be important to monitor. Okay. Realtor.com took the report, I think did a much better job than what Moody's did. And they laid it out for us. Okay. Treading water is New York. Treading water is California. So not in a recession, not an expansion like your Floridas, Texases, Pennsylvanias, Carolinas, Utah, where I'll actually be next week, your Arizonas, but more just treading water. In fact, the Moody's analysis went on to say that New York and California are hanging on like by their fingernails. Okay. So they're not expanding by any measure. They're not in a high risk situation where they're in a recession, but they're just like one bad thing could push them over the edge. In New York, what do you have to watch for? You have to watch for the S&P 500. You have to watch for the stock market. Oftentimes, and this is kind of how they closed out that article, what was talking about the stock market. Oftentimes we say the economy is not the stock market. A recession isn't decided by Wall Street. Yet if, Wall Street has a really bad downturn, the S&P 500 tanks, what do you think happens to New York City's economy, which is so interwoven in finance? Yeah, the economy goes down. It goes south. If the New York City economy in Manhattan goes down, what do you think happens to New York State? It goes from treading water and it goes into that recession high risk category. What do you think happens when one of the states driving along with California, driving 20% of the GDP's economy goes into recession? Well, that puts shockwaves through the rest of the country. A lot of recession depends on how consumers feel, their sentiment on what's going on. Now, if the S&P 500 tanks, what do you think happens to all those tech companies in California? California's economy is going to be beholden to tech companies and the S&P 500. Now, you can say this is bad and you don't like it, and you'd rather not live in a capitalistic world, but this is the reality of what we have here in the US, okay? We support our companies that are creating jobs and opportunities. And if they have to contract, those economies will contract, California and New York being two. The rest of the country will undoubtedly follow if that were to be the case. Now, what's interesting about this report, and Realtor.com points this out, this isn't in the Moody's report, but you have places like New York and California going to be dependent on, the U.S. greater economy for sure on what happens there. What happens with the stock market bouncing back today from the China tariff tweet or post on Truth Social, if you will, based on another tweet this morning saying, hey, China's going to be fine. We're going to be fine. We're all going to get along. So that's the stock market. But when you look at some of these states, when I look at, the Northeast, the rest of the Northeast, Connecticut and Rhode Island and Massachusetts, that up there, you've got some of the lowest housing inventory, which is creating home prices continuing to go up. Yet those are the locations that are at a high risk for recession economically, that are trending down, or at least trending in high risk. Their economies are not expanding. In fact, they're shrinking. When you look at the states that have high inventory on real estate, obviously there's been an investment in the states that expand. You see Texas, home prices going down there. Florida, Gulf Coast, home prices going down. Alabama, home prices are going down. Arizona. These are the locations, the Carolinas, where you have a lot of inventory. Yet these are still the locations today that Moody's is classifying as expanding communities, meaning that you should look into the future of these areas and say, well, the prices may not be going down forever. There might be some stability as it relates to home pricing in the future. Maybe that bottom is now, I don't know. But there might be some stability on home pricing because we're in those areas are in rather economies that are continuing to expand. Okay. Despite what's going on with the real estate market there, those economies continue to grow. They have a bright future ahead, which is why builders have decided to make their investment in the Texases, the Arizonas, the Floridas, and the like. Okay, so what economy are you in, according to Moody's? Are you in a receding high-risk community like the Northeast right now, or the Mid-Atlantic states, centered around D.C.? You have Illinois in that category. Are you in a just treading water area, a state that is kind of hanging on, and one bad thing could tip the scales? New York, California being in that category, or are you in a expanding community? Moody's Analytics believes that the economic recession nationally kind of hinges on the California and New York economies, and those two economies really hinge on what's going on with the S&P 500 and what's going on with the tech companies. The wider fate of American economy lies at either end of the country, California and New York. When you look at your real estate market, it is reacting basically opposite of how the state greater economies are reacting. And so there you go on recession watch. That word is going to continue to kind of pop up here probably through the fourth quarter as we move forward into the new year. Home builders know that word all too well. Home builders are right now sitting on an unsold inventory, completed inventory, homes that are completed, ready to have a buyer. There's nothing more expensive for a builder than a completed home sitting there, not being bought, just being shown or modeled off each and every single weekend. Home builder inventory right now sits at a 16-year high. This is completed unsold inventory. And the housing market is finding deals inside of this opportunity to cash in on. The highest level, according to this report from Resi Club, suggests that we're at the highest level since 2009. That was during the recovery of the great financial crisis. Here's recent data for completed unsold inventory. Okay, back in August of 2016, National Home Builders had 61,000 unsold completed U.S. single-family homes. That's been rising, obviously, here over the last 3 years with where the interest rates are, has been rising considerably. August 2023, that number was 72,000, 105,000 just a year later, and now this past August, 124,000 on completed unsold homes for sale across the U.S. If we look in comparison to the heart of the great financial crisis, the mortgage crisis, the numbers are staggering what we went through during that time period. Okay, 06, 07, 08. We were on the decline in the end of 08 into 09. July 2009, we had 121,000 completed unsold homes. We're at the highest level since that time, sitting today at 126,000. I'm sorry, I think I have that reversed. I think August is 124,000. July of 2009 was 126,000. So we're right there at the same level, essentially, that we were in July of 2009. Nowhere near the peak during the GFC. But we are on that climb up currently, as opposed to the climb down, which they were in 2009, before getting all the way down to about 40,000 in the double bottom of the market, 2012, 2013. Okay. But builders at that time, by 2010, 11, 12, they had just stopped building altogether. Now, builders are smart. What are they doing right now? We actually talked about this a little bit with Barry Habib on the Knowledge Brokers pod on Friday. Builders have pulled back. Okay. They see the numbers, they see the data. Okay. They know that we're at a historically soft level nationally as it comes to new construction supply. Okay. They're at a soft level, while just a couple of years ago, they were at a historically lower number, historically tight level on inventory. And they've seen this, and they've pulled back on housing starts. They've pulled back on housing completions. Okay. Primarily in these areas here, like Texas and Florida, where you have greater inventory. Okay. They've pulled back on those permits and housing starts and completions. And the risk here, if these numbers continue here now at a 16-year high, is home builders are just going to pull back more, which is going to create a longer-term issue on inventory. Okay. If resale inventory, unsold inventory, completed new build, rises into next year and continues to rise in the spring market, they will just pull back. You're not going to see single-family permits and housing starts at the level that analysts suggest we need them at into the future to meet future demand. They'll pull back. That'll create that supply-demand constraint that pushes prices higher into the future. So builders have been pulling back. They'll continue to pull back. We saw last month good month-over-month data for builders. They need more to be able to get back into a confident situation. They're going to certainly need more help from the interest rates. They've been having to stack in a lot of incentives. If the rates come down, even though national home builders can make a better rate, the overall rates coming down will help builders navigate that process. Okay. Last Friday, we saw a 10-year get under 4.1, just off of the recession fears, or the trade war fears, I guess would be a better way to put it. That number under 4.1 is a good sign for what might happen with long-term rates. and certainly the 30-year fixed mortgage rate. Here today, we're starting at 4.59 on the 10-year, and that continues to be under 4.1%. We'll see if that helps out the 30-year fix here today. Now, you don't want to, and this is kind of one of those things you get caught here. You don't want to have a low 30-year fixed rate, but a economy that is weakening due to, a conflict with China or other reasons. Obviously, 6.32 was the low number of the week where we ended on Friday. The Freddie Mac 30-year fixed weekly came in at 6.3, so kind of hovering around that 6.3 to high 6.3 range. Since the Fed meeting when we saw those rates pop up off of year-to-date lows. Speaking of the Fed, we will have some Fed speeches this week. We'll be watching for those. We're about 16 days out from the next Fed meeting. CME Group has us at 96, almost 97% chance that we will get a cut in 16 days at the next Fed meeting. Poly market is much the same, where there is a 92% chance in October, we will see a cut of 25 basis points. It's actually a 3% chance that that cut will be 50 basis points. All right. There's a kickoff here to the week. I'm looking forward to a great week with all of you guys. And then next week, I'll be doing the hot sheet from the road. If you are going to be in Utah, I'll be there in the beginning of the week. And then I'm heading over to Denver for the Fusion Rally, where I'll be delivering a keynote in the morning. If you missed me at BAM Camp, Sirhan or Jared James, this is your next opportunity to come join me at an event you should be at. October 24th, Fusion Rally 2025, Denver, Colorado. It's 9 days from today. The countdown is on. Use BZ25 to grab your ticket. This event right in Denver is happening on October 24th in Denver. If you're in the driving distance, get in the room. You're going to have some of the smartest operators in that room. This is high-level thinkers. I'm honored to be doing a keynote there the morning of October 24th. Use the link down below to grab your ticket to that. All right. That's what we've got. I do have cash offer update from our partners at Zoodealio. Every BAMX member gets the Zoodealio platform included in your membership. Go to bamschool.com/BAMX to grab that today. Zoodealio has the most data as it comes to cash offers, what's happening in the market right now. And actually, I guess I don't have. I guess I'll have that for you tomorrow. My apologies. I will have that data for you tomorrow. Thought I had it today. We're still getting that data. We'll get it for you tomorrow. Cash offers from Zoodealio. To get access to all of the slides used on the hot sheet, just grab it from school, BAMX members, school.com/BAMX. It's all there, as well as all of the notes for the show, school.com/BAMX. Every BAMX member gets access to the Zoodealio platform, and I will have Zoodealio's report tomorrow on top 10 cash offers for the week. There's your hot sheet. Looking forward to seeing you guys back here tomorrow. Until then, toodaloo.